To summarise, the temporal method is used to remeasure a subsidiary's balance sheet and income statement items from the local currency to the functional currency. This is appropriate when the subsidiary is well integrated with its parent. The current rate method, on the other hand, is used to translate a subsidiary's balance sheet and income statement items from its functional currency to the parent's presentation currency. This is appropriate when the subsidiary is self-contained and very much independent from its parent. Before we explain further on these two methods, let us first define a few exchange rates. The current rate is the exchange rate on the balance sheet reporting date. The average rate is the average exchange rate over the reporting period. So, if it is the financial statement for the quarter, the average rate is the average exchange rate over the past 3 months. And the historical rate is the actual rate that was in effect when the original transaction occurred. For example, if a subsidiary bought a machine on the 2nd of August 2019, the historical rate for that transaction at every balance sheet reporting date in the future would be the exchange rate on the 2nd of August 2019. Now that we're clear on the definitions of the various exchange rates, we'll start explaining the current rate method as it is the simpler and more intuitive method. The balance sheet is a snapshot of all the assets, liabilities, and equity of the firm on the reporting date. As such, the most appropriate rate to use is the current rate. Under the current rate method, all balance sheet accounts are translated at the current rate, except for common stock, which is translated at the historical rate that applied when the stock was issued. We'll explain more on retained earnings later. The income statement, on the other hand, tabulates all the transactions made during the reporting period. As such, the most appropriate rate to use is the average rate. Under the current rate method, all income statement items are to be translated at the average rate. If dividends were declared during the reporting period, they are to be translated at the historical rate that applied when they were declared. Now let's see how this works. In this example, the subsidiary's functional currency is in euros, and we are to translate it to the presentation currency, which is US dollars, using the current rate method. To better explain things, let's roll back to the last reporting date in order to have our beginning balance sheet. Let's say this simple subsidiary has €1,000 in assets, €400 in liabilities, €250 in common stock, of which the exchange rate was 1.4 when the stocks were issued. The remaining €350 is retained earnings. Given that the current rate at this point was 1.2, we have 1,200 in assets and 480 in liabilities. Common stock has to be translated at its historical rate of 1.4, which is $350. Retained earnings is complicated and we'll explain it later. For now, take it that the accumulated retained earnings on this reporting date is $450. Now, do you see a problem? We do not have a balanced equation in US dollars. Liabilities plus equity is $80 higher than the value of assets. To resolve this, cumulative translation adjustment is reported in stockholders' equity as a plug figure to force the basic accounting equation to balance. So in this case, CTA is minus $80 under stockholders' equity. Moving on, the subsidiary has net earnings of €300 for the period, and the average rate during the period was 1.25. €100 of dividend was declared, and the exchange rate on declaration date was 1.22. The increase in retained earnings for the period was therefore €200. Let's assume the rest of the balance sheet remains the same. The subsidiary's balance sheet in euros on the reporting date should look like this. Translated at the average rate of 1.25, the net income for the period was $375 and $122 of dividends paid. The increase in retained earnings in US dollar terms is therefore $253. And let's say the current rate on the reporting date was 1.3. The assets should be $1,560 and liabilities $520. Common stock remains at $350. Now, it is a common mistake to simply multiply the current rate to the retained earnings in euros. Rather, retained earnings is the beginning retained earnings, which is $450, plus the increase in retained earnings in dollars, which is $253. Ending retained earnings is therefore $703. Now let's calculate the CTA. Liabilities plus equity is $1,573 versus $1,560 in assets. This time round, the CTA is minus $13. The change in CTA for the period is a gain of $67, which is a gain from foreign exchange for the period. Under the current rate method, the foreign exchange gain or loss is to be taken direct to equity as other comprehensive income. To summarise, under the current rate method, all items on the income statement are translated using the average rate. Consequently, net income is also translated at average rate. Dividends paid in the period are translated at the rate on the declaration date. On the balance sheet, all assets and liabilities are translated at the current rate. Equity on the whole is also translated at current rate to balance the accounting equation. However, common stock is translated at historical rate, and retained earnings are adjusted based on translated net income and dividends paid for the period. The CTA is a plug figure to balance the accounting equation, and the change in CTA for the period is the exchange rate gain or loss. It's taken direct to equity as OCI. This gain or loss is not reported on the income statement.
You're watching an excerpt from our comprehensive animation library. For more videos like these, head on down to prepnuggets.com. At Prep Nuggets, let us do the hard work for you.